You're tuned in to the Tools of the Trade podcast.
Hey friends, how is everybody out there today in podcast land? My name is Colin and I am the host of this podcast, Tools of the Trade, where I interview construction leaders, extract their tools, share their stories, all in an attempt to give the construction industry a voice. And here we are, sitting at episode 6, which is the first episode since the official launch on October 31st. And so far, the feedback has been overwhelmingly positive. There's been people reaching out saying that they've really connected with some of the guests. I've had over 200 listens in a week, which is something that I really didn't expect to happen. And I want to first take a minute to thank anybody that has listened in on one of the first 5 episodes. And another huge shout out to anyone that has left me a review. You guys are the shit. I'm so humbled and thankful that you have taken some time out of your day to listen to me have a conversation with somebody I felt could bring you guys some value. And I really hope it has. If there's one piece of advice I could give anybody starting a podcast now that I've recorded over 20 episodes but released 6, is you got to keep pushing. It's tough to hear yourself on the mic. It's not easy to learn to interview strangers. It's not super easy to learn how to edit audio and make it sound good for people, but that's all part of the process. And like anything good, if it was easy, it wouldn't be worth doing. So just keep pushing and get it out there. I myself am continuing to learn. So thank you guys so much. I have a few quick things I want to say. First, please do not forget to check out my website, toolspodcast.com. On the website, I have so much more content for each guest. There's pictures, videos, favorite books, free downloads, episode timeline, links to everything that gets mentioned. There's just way more stuff to supplement the episode along with show notes. So please head over there and check out your favorite guests or the episode you're listening to now. And while you're there, you can also subscribe to my newsletter to get notified when new episodes are released or when anything cool I want to share with you guys comes to mind. I promise it is not a spam related or a spam email newsletter. It is only content that I want to share with you that's going to be of value, stuff that you can use. The second thing is this podcast obviously is not possible without all these amazing people that I am fortunate enough to get to sit down with and talk to. So if you know anybody or if you yourself feel like you would be a good fit for this podcast and you can bring value and give back to the construction industry and share a story, I would love to hear from you. So please, again, go to the website, toolspodcast.com, navigate over to the Get Interviewed button at the top, fill out your contact information there, and I will aim to get back to you in 5-6 business days. So that would be great if you feel like you would like to come on. We can have a chat. And finally, number 3 is these episodes were the first 2 that I ever recorded. The reason I'm releasing them now is because I felt like it would fit best now in the order in which I was releasing these episodes. But there is a few audio snafus. It was my first time recording remotely on Skype. We had planned for a 3-part series, which you will hear reference to in the episode, but it's only 2 parts, so please excuse that and a little bit of learning that happened throughout. But I promise the content in this episode makes up for that. So enough of me blabbering here. This week, I have a 2-part deep dive on 2 very important, dry but important subjects that relate to business and trades business in particular. Bonding and insurance. So in this 2-part episode, I'm joined by my good friend and CEO of Netsurance Canada, Scott Dekanich. Scott founded Netsurance as a way to help digitize an archaic industry and bring it online. Just like construction, we are technologically behind and we are still ruled by the dinosaurs in some respects. It's the same with insurance. So as Scott found that there was a need for higher quality information about bonding and insurance, being able to obtain quotes for free online without dealing with somebody directly, he founded this platform. So make sure that you head over to Netsurance, and if you are netsurance.ca, and if you're planning on getting a quote from somebody else for insurance or for a bond, make sure that you just at least head over there, if you're in Canada, of course, and type in the information as it pertains to your requirements for bonding or insurance and get a free quote. It doesn't hurt. You can compare it against the next guy. And if you have any questions, you can reach out to Scott and or his team through the website netsurance.ca. So in the first episode here, which you are going to get into next, is all about bonding. What is bonding? Why do you need bonding? What are the definitions of the various types of bonds that you require in construction for a construction company? So we deconstruct that and go down all sorts of little rabbit holes as it relates to bonding. And then episode 7, which is the second episode of this 2-part series, we do the same thing for insurance. Where do you get it? How do you get it? Why do you need it? What types of coverage do you need? What types of deductibles do you or should you think about having for a trades business? We're all familiar with car insurance, but when it comes to business insurance, it can get confusing. So we do our best to deconstruct this. Make sure you have your pen and paper ready so that you can take some notes. Again, head over to netsurance.ca if you want any more free information or a free quote. And with all that being said, let's jump right into the episode.
I've been involved in insurance and bonding for the majority of my life, to be honest, because my father was in the industry and he started his own company in 2001. And at that time, I was, 12 years old, something like that. But I was always hearing about it and chatting about it, listening to him at the dinner table talk about it or whatever. And from the time I was 16 years old, I got involved. I started working for his company. And, I didn't start out as an insurance or surety bond broker. I was helping with, general office administration stuff while I was on summer break from high school or whatever. And doing underwriter payments, helping with the accounting for the company. But as a whole, I was always kind of learning about the way that the industry works and what it takes to be an insurance broker. And after I had completed my post-secondary education, I started working full-time as an insurance and surety bond broker, which means I'm the client-facing representative for education and sale and everything involved with insurance and surety bonds. So that's how I got into the industry. That was in 2011 that I first started to get involved full time, and I've been in it ever since. In 2015, I started my own brokerage, and it's been operating ever since. Netsurance Canada, netsurance.ca.
And maybe you can just quickly dive into the way the insurance and bonding industry used to work and how you see the industry transforming and kind of where Netsurance is trying to position itself for the insurance industry.
Yeah, definitely. I mean, insurance has made leaps and bounds recently in terms of offering digital solutions, from electronic policy documents to certificates of insurance and things like that, even online applications and management. Email obviously is the most prevalent form of communications between clients and their representatives on the insurer side of things. And but back in 2001, it was primarily fax and mail, and email was starting to come into the equation, but it took a while to catch on, to be honest, and especially in Canada. In terms of bonding, it's still pretty ancient, to be honest. Like, a majority of surety bond contracts still require an original copy in hand of whomever's requesting it. They want that original piece of paper with a wet signature, they call it, which is like a pen signature, so that you can tell that it wasn't just done on a computer or something like that, as well as a seal, which is like a little imprint that you press into the paper. That's what majority of obligees or job owners that are asking for bonds want to see. They want to have that in their hands. And the industry's updated a little bit in terms of some owners and obligees are starting to accept digital bonds. And but it's really rare, to be honest. I would say still 95% of contracts in Canada are if they're requiring bonding, they want that original paper bond in hand, and that's the requirement. Yeah, so I think that you were saying something that I didn't cover off on the last question was how Netsurance is positioning itself as trying to remedy the situation in Canada of not really not being up and with current times on the digital solutions in the industry.
Yeah, exactly. So in regards to that, what is your aim with Netsurance? How do you plan to tackle this problem and provide a better solution for, I guess, not just contractors, but anybody looking for specific specialized insurance in general?
Yeah, so the main vision is to completely eliminate paper. No more printing, no more signing on a piece of paper, scanning it, sending it back, things like that. This can all be done digitally. And I think that, it's actually more secure these days in the digital space. Anybody can forge a signature on a piece of paper. If you're going to do it digitally, you can do things like, cell phone codes or verification devices that you can make it more secure than a piece of paper. I really think that it's like that. And so that's the goal with Netsurance. I mean, anywhere where I can eliminate paper, eliminate people having to travel to and from a location to purchase something that is really a completely non-physical product. It's just, it's a contract. So to put it in place, you should be able to do it completely remotely. If you need to sign something, that's okay. We can accept digital signatures. You can do it with your finger or with a mouse. That makes sense. And that's the goal for me. And in terms of bonding, I've been fighting for that for a while, to try to have obligees and owners that request the bonds start accepting digital signatures. There's a few platforms that have come out recently in the Canadian space for contract bonds that do accept digital signatures. They do, however, charge the contractor per signature. They also charge the broker who's signing on behalf of the surety per signature, as well as licensing fees and things like that. So, I mean, there are some solutions. I don't know if they're optimal, but with Netsurance, I'm trying to just make things as easy and modern as possible for contractors and just general insurance clients.
Awesome. Well, part one of this 3-part podcast, the 3 parts being bonding, what that means, and there's a lot of avenues we can go there, and a lot of things that we can uncover and help clarify, because I know that I had issues with the term for a long time, and even still do, in what it actually means and what people need in terms of bonding. Second part being insurance. That's a huge thing that everybody needs when they have a company, and as their company grows and evolves, and that's going to change as well. And also part 3 being overall risk mitigation. So I thought if we start with the bonding category, that it might be helpful to outline a few of the most commonly used terms and define them, so that anybody listening to this podcast has a better idea of what we're talking about from the outset, so that as we get into it, they're more familiar with the way that we're taking this. Yeah,
so I think it's important to outline first off that surety and bonding are 2 words that are often used interchangeably, and they can kind of mean various things. When I say surety, I could be talking about a surety company, or I could be talking about the bonding industry in general, saying a surety contract, a bonding contract. It's all kind of the same thing. Those words are interchangeable. And a bond is a 3-party security contract or security agreement that basically is one party providing a financial backing to another based on the performance sometimes, or something that the principal is going to be doing for the obligee. So the 3 parties in the 3-party security agreement of a bond are principal, which is typically the contractor in the case of construction bonds, the obligee or the owner, which is the one that is being provided the financial guarantee. So that's the one with a financial interest in this bond. And the third party is the surety company or the bonding company, whatever you prefer to use. And that's the one that's actually providing the financial backing on that bond document. And in the event of a default, which is whatever the bond is outlining should not happen, happens, that's when the obligee can make a claim under the bond and the surety company would pay out whatever the penalty amount of the bond is.
Awesome. That's great. So with that in mind, one of the common misconceptions that you brought to my attention a little while ago, and I'll just quickly share my experience. When I started my first company and we were looking at getting a vehicle wrapped, and you're starting to think about what you put on the side of that vehicle, oftentimes it's 3 words: licensed, bonded, and insured. And the word bonded always just got tossed into that mix and got put on our vehicles, but we didn't even really know what it meant. And we were usually getting these vehicles made up before we even needed any sort of bond. And still to this day, I see a lot of people driving around with those 3 words, licensed, bonded, and insured, on their vehicles. And I was hoping that you could dive into that word a little bit more and what or why these people may be using the word bonded on their vehicles.
Yeah, sure. So at this point, I think I should differentiate 2 different types of bonds that are the primary types of bonds, and they are contract bonds and commercial bonds, which encompass license bonds. That's a type of commercial bond. And I think that that's the most common type of bond that contractors are claiming when they put something like that on the back of their vehicle or want to advertise it to their clients that they're bonded. They're talking about a commercial bond, and commercial bonds or license bonds are typically lesser amounts than a contract bond. And a lot of the times, depending on which province you're in and the requirements of local licensing, they're in the amount of something like $10,000, and they're basically created as a barrier to entry for new contractors in the field, that somebody is willing to post a security for their business for that $10,000 amount. And really the approval process for a small bond like an electrical contractor bond or a gas contractor bond is along the lines of, you're not in a court litigation at the present or in the past 5 years. You haven't declared bankruptcy in the past 5 years, and you haven't been declined for bonds elsewhere in the past 5 years. So if you can say no to those questions, you're most likely approved for your license bond. And when you see an electrical contractor, for example, putting licensed, bonded, and insured on the back of their vehicle, that's probably what they're referencing. They're talking about that they were able to obtain their electrical license bond, which is a commercial bond, because it was part of their licensing application with the local safety authority, for example. And what that bond says is they're going to follow the Safety Standards Act procedures in their operations. And there's a third party that's willing to back them for that work, that they're going to follow those. And so that I think that would probably be the most likely scenario for a majority of contractors that are claiming that they're bonded. On the other side of things, there's contract bonds, which are typically larger. And, I would say a standard amount to see contract bonds being implemented in the construction industry would be in the range of a $200,000 contract, somewhere around there. Although I have seen and issued them for smaller jobs, even around $50,000 I've seen them. But those are typically for municipal contracts, not for private contractors or developments or anything like that. But I think that we're going to go a little bit deeper into contract bonds later. And that's primarily what a contractor would be advertising when they say that they're bonded, that they have a commercial bond or a license bond in place for their business that was most likely required to get their license. Right.
So I know you probably can't speak for any other provinces in Canada or anywhere in the States for that matter, but just so that we're clear, if somebody was to go out, let's say they're in BC, they're a plumber or an electrician, they're starting a company, in order to become licensed, that is a requirement, is to have that bond in place through the local safety authority.
Yeah, that's correct.
And
so
how much?
BC Safety Authority requires that. How
much does that bond typically cost?
Yeah, so for a contractor to obtain that bond, its standard price is $150 per year, or if they want to commit to a 3-year term, it's $350. So it's pretty cheap, and that's how it's been for quite a while as of today's date. And they renew each year for the same amount. If you want to commit to a 3-year term, it's $350. 1-year term, it's $150. And the safety authority in whichever province you're in, or there could be other entities and bodies that require those bonds to be on file, they hold the original copy of the bond because it's of value to them. It's essentially the value of whatever the penalty limit is. So in the case of electrical and gas contractors in BC, it's $10,000. For each contractor, the safety authority is holding one of those bonds that in order to keep their license valid for the specified contractor. And so it's a reasonable price.
And now if somebody, let's say somebody didn't opt for the 3-year and every year they're renewing this bond that they need, or is there current history being reviewed every single time they pull that bond? Like, are they doing a physical background check to say, hey, has this guy declared bankruptcy in the last 365 days? Does he have any red flags? Is he getting reassessed, or is it just a one-time assessment?
Yeah, not really, to be honest. I don't think that there's much of a follow-up from the surety companies or the safety authority for, anything that could, as a part of the application process, prevent them from obtaining the bond in the first place. Once it's issued, it's not really followed up on that much. But to be honest, in my, almost 13 years experience in the industry, I have yet to hear of a claim under one of these commercial license bonds. So the safety authority, I mean, I really think that they're utilizing it as sort of a barrier to entry for new contractors. They just don't want somebody that they don't feel comfortable getting a license and operating as an electrician or a gas contractor or other type of contractor to be walking around and doing business if they, their character isn't deemed bondable.
Fair enough. That makes sense. So if that's considered commercial bond, commercial license bond, and then you briefly touched on contract bonds, and I know just from my previous history in the construction field that there's a ton of different types of contract bonds that we could get into. But what would you say is the most typical bond that a contractor, maybe he's got a few guys now, he's going after a larger scope of work, and he finally gets that tender package, and that tender package says that he's required to get a bond of some kind. Let's say, for argument's sake, that it's a sub-trade, so a plumber or electrician. What type of bond would that be typically, and what would be the steps that contractor is going to have to go through to get that bond?
Yeah, sure. One more point that I wanted to touch on related to commercial bonds before we move on to contract bonds was there's other type of insurance products that are floating around that have the word bond in them. And I think recently the industry has tried to change that. One of them was called a fidelity bond, which is not a bond at all, but it's an insurance product. And it was primarily used as an instrument for risk mitigation of employee dishonesty. So if you have an employee of your business and they're on site at somebody's home and they steal something, for example, that's coming on your business and there's insurance coverage for that. Limits are typically pretty low, but that was something that they called a fidelity bond, sometimes a 3D fidelity bond. And now they are, I think a lot of different insurance companies are starting to call it crime coverage. But I think that some companies would say that they're bonded when they have that. And one of the types of businesses that would say that on a regular basis is cleaning companies, for example. They would say we're bonded, and people would ask them, if you're coming in to clean our commercial space, for example, are you bonded? But really, it's an insurance product, and it's not a bond at all. So I thought that was important to touch on. And really, when people are looking at hiring a contractor, they should be more concerned of that they're insured rather than them saying that they're bonded. The liability insurance aspect and potentially crime in the case of employees having access to other people's property and things like that, that could be applicable. But commercial general liability is an insurance product that people should be primarily concerned with when they're looking at contractors and selecting one to perform on whatever project they're talking about. I've also come across dog walking companies that have said that they're bonded, and I know that a bond doesn't exist for that. So me being curious, I would reach out to them and say, hey, I'm looking to get my dog walked. Can you provide evidence that you're bonded, please? And honestly, most of the time, people have either snapped or been really agitated and like aggressive towards me that I caught them lying about their business. And anyways, it's just something interesting in business that people like to claim that they're bonded when they really don't know what they're talking about. But yeah. So that's the last thing that I wanted to touch on for commercial bonds. But
I mean, it's important. I like, even myself, to the layman or the person that's not in the industry or has no idea what a bond is. I think back to the old saying, your word is your bond. And to some degree, that's what bonding is, as kind of a 50,000 foot overview. It's an agreement that you're going to do what you say you're going to do. But no, I think that's great that you were able to clarify that, because I think a lot of people don't quite understand what it means and throw the term around. And I think it's important that we got to the bottom of what exactly it means on the commercial side. But back to what I was saying on the contract side. So if somebody's been asked or is required to have bonding, or they're required to be bonded for the first time, what typically from a sub-trade perspective would that bond be? And what would be the steps necessary to obtain that bond?
Yeah, sure. So when we're talking about contract bonds, there's various types that we can talk about. The most common ones that people are looking at for their first time when they come across contract bonding as a construction contractor is most likely a bid bond or a consent of surety. Those are pre-qualification bonds that are submitted during the tender process. So, when we have a general or an owner, which is also the obligee, which we had discussed before, when they are looking for quotes on a new project that they're trying to complete, they could request a bid bond and or a consent of surety for that project. And it's a document to be submitted during the tender with the quote from the contractor that proves that they are truly bonded. And in this case, it's a different bond than what we were talking about before. There's a lot more in-depth underwriting that goes into the process of obtaining contract bonds. We're not just talking about, hey, have you been sued in the past 5 years or something like that. We look into everything from the financial statements of a company to what type of projects they've completed in the past and just their general history. And there's something in the surety industry called the 3 C's of surety. And They are character, capacity, and capital. And those 3 C's are reviewed by a surety underwriter or the bonding company to determine if a contractor is in fact bondable and to what extent they are bondable. What size contracts are they able to complete? What size contracts is the surety company willing to financially back them and, provide a form of risk mitigation to the owner or obligee for the contractor to come in and do that project for them.
So can you maybe just go into a little bit more detail of the 3 C's, character, capacity, and capital, and just sort of deconstruct those a little bit and explain them a little bit more so that we get a better idea of exactly what the surety or the bonding company is reviewing in each of those C's if somebody was to apply?
Yeah, so the first one being character is essentially exactly what it sounds like. It's the character of the contractor that's applying for these bonds. Now, that could mean various things from what we had discussed on the commercial side of things, like have they been in some sort of court litigation recently? Have they declared bankruptcy recently? Are they jerks in general? Do they have negative reviews everywhere? Do they have a bad name in the industry? That's something that the surety company takes into consideration when they're looking at bonding a client. That's their character.
And would they ask for like a supplier reference or something like that potentially?
Yeah, so part of the application process for a contract bond facility, which is when you apply for contract bonds for the first time, it's not something that, hey, I need a bid bond for this project. How do I get it? How much does it cost? It's actually an annual subscription and quite an in-depth application process that is a long-term relationship, similar to one that you would set up with a banking institution. So the surety company, you can look at it in a similar fashion. And the bonding company might want to see letters of reference from other contractors that you've done work for, things like that. They might even call them and have a chat with different relationships that you have with different contractors in the industry, maybe owners of other projects that they've done business with in the past, even if it was under a different outfit than where they're operating under now. The people themselves are looked into as principals of the company that's going to be bonded.
Okay, great.
Yeah, so the next one that we were talking about is capacity, and that is the contractor looking at this project and wanting to bid on this project even able to complete it? Do they have the manpower to do it? Do they have the expertise to do it? Have they completed projects that are similar in the past? Like I said before, even if it wasn't under the same name or outfit, that's not necessarily a problem. As long as the people managing the project have the capacity to complete it, then they should be able to obtain bonds for that project. Although there is the most important C that we haven't touched on is the capital. But capacity is definitely important. They need to know that they're going to be able to complete the project realistically. Do they have suppliers that are going to be able to produce the materials that they need to complete that project, depending on what it is exactly? That's all part of the capacity that the surety company's looking at.
Now, what if somebody is looking to get bonding for the first time and there's no history of capacity? Are they required to provide some sort of proof that they're at that stage in their life as a business owner or as a contractor where they can have the capacity to complete that project? Or, for example, like if somebody has worked for a company for, let's say, 20 years and they were a project manager, superintendent, somewhere where they have the capacity and the character to manage a project of this size, but they're just starting out in their own shop and they're going after a larger contract. And let's say they do have the capital in place. What types of things are they checking to make sure that there is capacity?
Yeah, I mean, job history is definitely important. If it is a new venture for the contractor or the business owner that's looking at a bonded project for the first time, don't hop. The surety company isn't going to be interested in looking into you further if the first job that you're looking at is $10 million. Unless you were the general manager of some large outfit in the past and you've already got the capital in place to proceed with a project of this size, you should start small. Start under $1 million. Start under $500,000. Get a project. Try to bid on a project and win a project that's in the range of $250,000 or something like that. A small municipal contract where you could have a relationship with whomever's managing it, who the owner is, something like that. Could be a private project too that requires bonding, but the key is really to start out where you fit in. So I would recommend for new contractors looking at bonded works for the first time, unless you have some expertise, and this is just the first time that you're looking at bonding, then it's probably not a good idea to look at big jobs first. You want to start out small, and that's considered small in the surety industry, a $250,000 project. But I've had a client in the past that was really niche. They do remote bridge building. So they did the bridges on the West Coast Trail in BC, which are pedestrian bridges for recreational hiking, essentially. But, how does a contractor get that job? What type of history do they need to get that job? Are they helicoptering in a bridge in the middle of nowhere? How's it going to work? If they don't have any experience in that, a surety company isn't going to be confident that they're going to, financially back them to complete something like that. And the owner should be, that's primarily why the bonding requirement exists on that project. They need to be confident that somebody else is backing them financially for if they have a default during the project, which a default, we had mentioned it before, but we hadn't really explained what it was. Default means when a contractor is unable to fulfill the contract that they're working on. So if you have a project and you're taking too long, the quality is not where it should be, something like that, the owner can then claim default of the contractor, at which point the surety would be contacted and the issue would try to be remedied in a way that makes sense. Now, whether that means it's just a kick in the butt from the owner and from the surety company that you guys need to step up your game on this project, or it was a complete flop and they don't want them working on the job anymore. The surety company needs to, in the event of a default, pay out whatever the cost is to the owner to have the job where it should be. Hiring a new contractor, whatever that may be. That's definitely important. And
if somebody defaults on a project, is it similar to and obviously I have no clue the answer here, but is it similar to getting in a car accident where your premium goes up? Is there any penalty you have to pay the next time you get bonded, or is that red flag or strike against your account of serious detriment to the next time you get bonded? Like, what's the repercussion besides the financial penalty that somebody's going to have to go through if they default on a contract?
Yeah, I mean, it definitely is a red mark on your history for sure, as a person and as a business. And you mentioned a car accident, which is something that's important to mention, is that surety and bonding is in some ways similar to insurance, but in another way, not like insurance at all. in the sense that insurance predicts claims. If something happens on a job site that's covered under insurance, for example, the insurance company, they took the initial premium for future risk on that project or operations of a contractor, that if a claim occurs, that they pay out what the claim is. In bonding, if there's a default or a claim on a contract bond, the reason that there's such an in-depth application process and the surety company looks into the financial statements and things like that, there's the contractor's on the hook to the surety company for whatever the loss was. So although the surety company will be paying out the owner or obligee if there is a default, they're trying to recover those funds, and they want to make sure during the underwriting process that they are able to recover those funds from the contractor. So they need to have adequate finances to pay out the surety company in the event of a claim, a loss, or a default. That's why it's quite difficult to get bonding, because, in one sense it's really good. The bond enables the contractor to free up their finances in terms of working capital, and they don't need to tie it up in a letter of credit or something like that to guarantee performance on a job. But in the event of a claim or a default on the contract, whether it's through assets or cash or personal assets of the owners of the principal, which is the contractor, the surety company wants that money back. And there's something called an indemnity agreement that's signed by the contractor to the surety company when we set up a bond facility initially. And what it says is, in the event of a default, the surety has the right to your assets. And that the underwriting process is, it goes quite deep, and all the bonding companies want to make sure that they're able to recover from a contractor if something like that happens.
So basically, once you start out and you start going down the path of bonding and getting bonded, and no matter who you work for, if your name is attached to that, it's like you mentioned before, play within your wheelhouse. Don't take on anything that like don't bite off something that you can't swallow, and start small and build your experience and your reputation up that way, because it sounds to me like, not only could you lose potentially everything if you play with the big boys, but having that red mark on your history is just going to prevent you probably for life to be able to get proper bonding, because it's tied directly to your person with the character aspect.
Yeah, it could. But to be honest, most of the time, if something's not realistic for a contractor to be participating in a bid or starting a project, they're not going to be able to get the bond anyway. The surety company does their due diligence during the application process, and we can talk a little bit more now about what that application process is. Like I had mentioned before, we look at the financial statements of a company. We want to see how profitable they've been. What assets do they have? Do they have a bunch of equipment? What assets personally do the owners of that company have? Do they have any other interests? Do they have any ownership in other businesses? That's all important stuff. And really the main things that a surety company looks at in an application process, there's a general application to give a background about a contractor, what their job history's been, what they do, what they plan on doing, maybe resumes of the owners, things like that. And typically review engagement statements from an accountant want to be reviewed by the surety company. And that's different than notice to reader or in-house financial statements. Review engagement statements are a little bit expensive, but essentially you're paying an accountant to review your statements for the year, and at each year end, typically for the past 3 years is what a surety company wants to see when they're looking at a company for the first time and when they want to get bonding. The last one that I mentioned before a little bit, the personal assets of the owners, but they want to see personal financial statements of the owners. What are their assets? What are their liabilities? Is that positive? Is that negative? What's their annual income? Things like that, because they're personally on the line in the event of a default. If they can't perform like they say they're going to, whether it be a bid bond like we had talked about, and this will segue into the other types of bonds for contract bonds that we can talk about. But they want to make sure that they're going to be able to recover the funds. So it really depends on the contractor what we're looking for in terms of an application. But those are the main things: financial statements, overall what the company does, what its history is, resumes potentially of the owners, what their current work on hand is, what jobs they have on the go right now, because there could be some big projects. They might have a 3-year contract on the go, and that ties up capital and capacity. So that's of concern to the surety companies too. They want to make sure that they're not overextending themselves, have all these other jobs on the go, and now they want to take on another bonded one. This is all determined when we're setting up the bond facility, which is an annual subscription to be able to provide these different types of contract bonds. So I can list the ones that are most common now: bid bond, consent of surety, performance bond, labor and material payment bond, and a maintenance bond. Those are the main ones that we see in municipal contracts and private contracts too, for the larger scale stuff. And when you set up the bond facility initially, there will be limits determined that you can work within. It will say you have up to 500,000 single job limit, which means you could bid on and perform bonded works for up to $500,000. And then it might say you have a $1.2 million aggregate limit, which means all the other projects and contracts that you have on the go, whether they're bonded or not, your total work on hand can't exceed that $1.2 million amount. And one single job that they're going to bond cannot exceed that $500,000 amount. Depending on the situation, the surety company could review a specific project. If it's, say, $580,000 and it's within the company's expertise, the contractor's expertise that's going to be bidding on it or wants to perform, they might say that, you know what, that's okay. They did one last month that was $400,000. They just completed it. And we feel confident that they would be able to do, if the contractor feels confident, the surety company is willing to back them on a bid that is in excess of what the initial limit that was determined during the application process is. It's taken on a per project basis. It's reviewed for sure.
Right. And I know from the sounds of things, bonding usually starts at the owner level. So the owner that's getting into bed with a contractor's getting into bed with subtrades, and there's all these requirements for the subtrades and also the contractor to perform on the project. But does it ever go the other way around? So if you go and you get yourself bonded and you have the character, you have the capacity, you have the capital, this is a great project. You pull out all the stops, and 3/4 of the way through the project, the contractor himself defaults. Is there anything that's protecting the subs below him from a bonding perspective for getting paid or anything like that? Or is that a separate topic?
Yeah, so that would be a claim under the labor and material payment bond if one is in place on a project. It essentially guarantees, the surety company is guaranteeing the payment of not only subs to the general on that project, but also to the suppliers. So if there's a default and subs and suppliers aren't getting paid, they can make a claim under the labor and material payment bond if one's in place on the project, and the surety company will pay that out to them.
And is that something that a sub-trade or a contractor could request if they felt uneasy about getting into a project with somebody that maybe they don't know or they haven't done too much work for in the past?
Definitely. I'd recommend that. And I think that from a sub's perspective, that if you know something like that and you're asking the contractor that, I've seen that happen in the past where I've had a client that was subbing to another contractor and they had asked me a similar question. And I told them, yeah, ask them for evidence of the labor and material payment bond. And the general actually, they got insulted and they were, I don't know. To me, if you're getting insulted by something like that, you have something to hide.
Yeah.
If you don't have something to hide, then show them evidence that there's labor and material payment bond. They have concerns of getting paid potentially. They don't know you. Don't be on a high horse. Show them the evidence of the bond.
Yeah, and I mean it's so common that everybody starts out projects for the most part with good intentions, and it's important to cover your ass. You gotta look out for yourself, because at the end of the day, especially in construction, typically, and the way that I kind of look at things is there's a hole in the ground and somebody's expecting you to put something there, and there's all sorts of factors that can compromise that project. So I think you made perfect sense there. If somebody's getting frustrated or angry, or they take offense to the fact that you're asking for something like that, then they potentially have something to hide. I mean, that goes back to the dog walker that's saying they're bonded and you ask for it and they kind of get a little disgruntled back at you. I mean, it's if people have that intent and there is that goodwill inside them that no matter what happens, that payment's going out, then they should probably have that in place. And I think you're right. Asking for that makes perfect sense.
Yeah, it's a good idea. And I mean, the sub doesn't need to be bonded to have that bond apply to them. There's guidelines for generals requesting bonds of their subs where that limit is, and it varies depending on the surety company that's providing the bonds. Most of the time, I see if there's a big general and they're doing a job that's $10 million, they might say any of your subs that have a portion of this contract that's in excess of $500,000, ask them for bonds. Ask them to provide bonds to you. And I think it's a good idea. It also, it weeds out those that aren't able to get bonds. And bonding is a bit of a big boys club. Like, the amount of times that defaults happen, it's quite rare, to be honest. When a default or a claim under a bond happens due to a bankruptcy and not like some sort of a performance issue or something like that, everybody in the industry hears about it. And it's not something that happens all the time, to be honest.
Is it made public?
Yeah, most of the time it is made public. There's publications and I'd have to look into specifically where it would be published depending on what field it was in and that sort of thing. But within the surety industry, word gets around for sure.
Yeah.
So, but why don't we talk a bit about the different types of bonds that we had chatted about under the contract bond umbrella?
Yeah.
What does a bid bond even mean? People are looking to bid on their first contract that requires bonding, and it says they need a bid bond.
Yeah.
Well, they should look into what other bonds they're asking for if they're successful. They might say they need a bid bond during the tender phase, but that's only relevant to them providing a quote for that project. And what the bid bond is guaranteeing, standard value that I see on contracts in Canada is 10%, but there's other values that it could be for. And what that means is, in the case of this contract that the contractor is trying to bid on, for the owner specifically, that bid bond piece of paper that a surety company is going to be providing guarantees the owner that they will forfeit 10% of the quoted contract value or the tendered amount. 10% of the tendered amount can be forfeited from the surety company to the owner if the principal or the contractor bids on that project and then they can't proceed with their works from there. If they bid on it and they win it, and then for whatever reason, they made a mistake on their bid or something like that, the owner wants to be indemnified for that in some way, that they just awarded this project to the contractor and they're not going to be able to fulfill their claims during the tender from what was included in their tender.
And is that dollar amount typically, would you see it being used because now that contractor may have to go with the second lowest number, meaning that they're going to have to potentially forfeit some dollars to take on that larger contract? Because I know if somebody was to come back to me and say, hey, by the way, you lost, but now you won because the guy in first place dropped out, he can't complete it, we're coming back to you. There's no way that I'm going to lower my contract amount unless I have a super tight relationship with the GC. But I guess would that 10% be used to help bridge the gap between the two different bid prices for that contract?
Yeah, for sure. That's one reason, definitely. And I mean, another one, again, is just that whole pre-qualification process and the big boys club aspect of being bonded. Definitely there's going to be a gap between the first place and second place bidder. How much that is really depends. And a bonding company is interested if one of their clients is successful on a tender, they win a project, they want to know who the second and third place bidders were. What were their bids? Was the gap 20%? Because that's not good. They just left 20% on the table. Well, what do they know, or what can they do that the other guy that's in second or third place can't do? Or were they just padding their bids so much that they were looking at margins of 50% or something like that? Mm-hmm. But that's definitely the reason that you had mentioned, is that's one of the main reasons for sure. And it's just a pain. It's a pain to award somebody a job and then they can't proceed.
Yeah. There's
lots of paperwork, bureaucratic stuff, especially if it's a municipality contract. Building roads, building bridges, things like that.
Yeah, most definitely.
So yeah, the next one that we can talk about is a consent of surety. And that's not a bond document, really. It's more of a guarantee. Yeah, it's more of a guarantee that something called final bonds will be issued in the event that a contractor is successful on the tender. So final bonds encompass the ones that we had talked about before: performance bond, labor and material payment bond. Those are the two most common ones that we see for construction contracts in Canada. And majority of the time, I would say in excess of 90% of the time, we're seeing the following requirements. If there's a consent of surety required during the tender phase, that states a 50-50 bond, which a 50-50 bond or 50-50 bonds are a 50% performance bond and a 50% labor and material payment bond. And when I say 50%, that means 50% of the tendered amount. So whatever the contract value is determined to be between the owner and the principal, when the principal submits their tender, the two bonds that are going to be issued as final bonds are 50% of the contract value. So let's say there's a contract that's $1 million. The performance bond, if they're successful on the bid process, the performance bond is going to be $500,000, and the labor and material payment bond is also going to be $500,000. Those are just standard amounts on most contracts in Canada. That's what the owners want to see from the surety companies, from the principals, when they're successful on a bid. And the consent of surety is a document that says, if they're successful, we guarantee that we'll get these performance and labor and material payment bond. It doesn't mean that a performance and labor and material payment bond can't be issued if they're successful on the tender, if a consent of surety isn't asked for. It doesn't mean that. It just means that the surety is guaranteeing that if our contractor is successful on this project tender, that we will issue these final bonds. So that's what a consent of surety says. And that, again, that's a document that's included in a tender package. So the only documents out of the ones that we had chatted about during the quoting or the tender phase that would be issued are that bid bond and the consent of surety. Right. Now, you can do both. You can do just one or just the other. But in general, as an owner, project owner, an obligee looking at GCs that are going to manage their project, I would recommend for them to ask for both a bid bond and a consent of surety during the tender phase. Why not? Makes sense to request the full gambit out of the gate. And that is a lot of what we see. Sometimes it's just a bid bond. Sometimes it's just the consent of surety. But in general, it's a good idea to include that in a tender from an owner or obligee's perspective.
Yep. No.
And so we can talk a little bit more about those performance and labor and material payment bonds and what they guarantee.
Yeah,
we had talked about the labor and material payment bond already, because you had mentioned if you're subbing on a contract, what you should be concerned about from the general, if there is a bond that's protecting your payment for the works that you're going to be doing, or if you're the supplier, for example. But I should also mention that depending on which province you're in, there's different taxable amounts on contracts. So I said before that if a project, for example, was $1 million, that might include GST. You might need to include GST on that amount. So it could end up being $1,070,000, and then the 50-50 bonds would be for $535,000 each. Not like we had mentioned exactly $500,000, but anyways, that's specific per province, and also in general in the surety industry, it's changed a little bit. During my career, I saw HST be applicable at one point, so it was 12%. Yeah. That would be included in the bonded value of a project. So if they were successful,
would be out here in Ontario, it would be the 12%.
Yeah, exactly. So that's important to note when you're looking at how much a bond's going to cost, which is also something that we haven't touched on. What does a contract bond facility cost, and what do issuing these other bonds, bid bonds, consent of surety, performance bonds, things like that, what does that cost? But let's just finish off explaining what the performance bond is.
Yeah, please do.
We already went over the labor and material payment bond. And again, those standard amounts of 50% on each of those, that might not be exactly relevant to every project, but in general, it's probably sufficient to be making adequate claims under a project. 50% of the value is allocated towards performance, 50% allocated towards payment of the subs and suppliers. But the performance bond is exactly what it sounds like. It's guaranteeing the performance of the contractor to the obligee. And to make a claim under that bond, the performance would be deemed inadequate. And that's when they would, send a letter to the surety company as well as the contractor stating that their performance is inadequate on this project and they're looking to make a claim under the bond.
And so that's purely discretionary. Like, let's say somebody has unrealistic standards and they pull that card out of their pocket. They send something to the surety company. They send something to the contractor and say, hey, you're not going fast enough. But maybe the work environment or the conditions of the job site aren't allowing those contractors to work fast enough. Maybe there's trade stacking. Maybe the project started late and you got every company's in there. Everybody's working on top of each other. The environment's crowded. It's dangerous. Is there an appeal process? So obviously, I'm assuming the surety company is going to look into this claim, and do they have the right to object the claim from let's say the general contractor based on the performance of his sub that he is issuing the claim to?
Yeah. So that's something else where, what you had mentioned about a subcontractor, like it might not even be the fault of the general that a job isn't on time. It might be the sub's fault, in which case it would have been important for the general to ask for a performance bond, for example, from that subcontractor. And there is an appeal process, but essentially once the owner notifies the surety company and the principal, it's pretty fast. Everybody's responding pretty fast. They should be. The surety company's on the contractor's ass, quite frankly. If there's a letter of default from the owner saying that something's not going properly, whether it's not on schedule, whether it's not to the quality that they had expected and determined within the contract documents or something along those lines. The surety company's contacting us. I hadn't really mentioned my role in all of this, but as a surety bond broker, I'm the link between the surety company and the principal or the contractor. I'm basically a mediary between the two.
So does that letter get issued from the general contractor to you, and you're facilitating the conversation to the surety company?
No. So the letter would be issued from the obligee. If there was a potential default, the letter that would be outlining what the issues are would be issued from the owner. The owner would send it to the principal and to the surety company, and I would most likely see a copy. Like either the surety company would send it to me, or the owner would have already been aware that I am the bonding broker for that client, and they would be including me in the conversation already.
Right.
So once the surety and once me as a broker and the contractor are notified, we're on the phone with them right away, something along those lines, figuring out what really is the issue. They say that it's this. What's happening from your perspective? There's always two sides to a story. And then the surety company wants to come to a solution without paying out, obviously. And, maybe the principal will admit that, they are behind. Here's the reasons why. With bureaucracy and things like that, maybe the relationship isn't that open between the owner and the contractor. And whoever had issued that letter in the first place hadn't even chatted with the contractor already. Or maybe they just had a few problems already, and the contractor kind of shrugged them off and was saying, oh, they're not that concerned. And that this makes it more serious, issuing a letter that potentially claiming default under the contract.
Right. So when you were mentioning earlier that you don't see a lot of these bonds go into the default stage, that's probably because it's resolved at the letter of default stage.
Yeah, exactly. When the letter's issued, usually the contractor pulls up their socks and fixes whatever the issue was.
Yeah. Calls all his buddies and says, you need to get on site because I'm about to default on this project. I need guys.
Yeah, exactly.
But is there any sort of mediary or adjuster similar to insurance that gets sent out? So say, for example, the performance is a quality issue, and the sub says, my quality is right where it needs to be. And the obligee says, no, absolutely not. This is not up to the standard that we agreed upon. Is there somebody that's making that decision as a middleman?
I think at that point, really depending on the project, it would probably go to litigation. It would probably go to the courts.
Fair enough.
Yeah. So, the surety isn't allied with, they are allied in a sense with the contractor, but, if they're not trying to prove that the contractor's performance is good enough, if the owner says it's not, they're listening. There's a reason why they're saying that. And, if the contractor is not being cooperative with the surety or the owner, it would probably go to court, and, potentially the surety, for reputation's sake, would just pay out the penalty amount immediately to the owner. And then they would try to go into recovery mode from the contractor and, go after the assets that they had signed away in the indemnity agreement, which is the document that's signed when you set up a bond facility initially, that says the surety company has the rights to my assets if they're held liable for a claim or a default.
Makes sense.
Yeah.
Was there any other bonds specifically that you think would be worth mentioning or speaking about that may or may not come up for somebody either just getting into the bonding world, or somebody that's been in it for a long time and may come across something unique or different?
A maintenance bond is one that's issued less regularly, I'd find, and maybe that's been due to my client base, but it's seen for a lot for painters, for example. I've seen it issued on larger scale landscapers that have done public parks and things like that, and they're installing benches or gardens, things like not to say that it's covering the foliage or the plants or something like that. But, if they had all these benches put in a park and then all of them are breaking, that's a problem with it could all be deemed part of the maintenance period. And the maintenance bond basically guarantees the materials or the work that has been put into a project for a predetermined amount of time. And like I had mentioned, it's about 2 years. Under the standard 50-50 bonds that are issued, typically there is a contract sort of maintenance period that's built in already for 1 year. So if the work is not to quality 1 year later or within that single year, which can also be extended depending on what the project is and depending on what the contract documents say. But maintenance bonds, not issued as much, I find, and it's for longer term maintenance periods. But paint's a good example of a commercial painter that does a large building and then it starts to chip 6 months down the road. The owner might want to know that there's a maintenance bond in place. And that one's issued actually once the project is complete. So a maintenance bond would be issued once a project is complete. We talked about bid bonds and consent of sureties, which are issued during the tender phase. Performance and labor material payment bonds, which are issued during the contract phase while they're actually performing the works. And then the maintenance bond can be issued once the project's complete for a predetermined amount of time.
And the maintenance bond, that would kind of be almost like ensuring that, in the example you gave of a painter, it's almost like ensuring that there's a warranty process, that if that paint does start to chip and fall off the side of that building, that they are going to come back and they're going to repair it, and it's going to be of no charge to the obligee.
Exactly. And if they don't, they can make a claim under the bond.
Right.
That's why they want to know that it exists.
So when I hear the word maintenance, the first thing that runs through my mind is somebody that maybe bids on a maintenance contract that goes into a big facility, for example, a pipe fitter or a steam fitter or something like that, and they're going in and maintaining a facility that's maybe been active for 30 years, and it needs a regular maintenance team, but they don't deploy one themselves, so they go to market, they get a contract, or they put out a request to tender on the maintenance of that building. Would that maintenance bond have any validity in that space at all, or is it completely separate?
Yeah, I would think, and again, this is where we could run into some potential overlaps of what it falls under bonding and what would fall under insurance. There's something that's part of a commercial general liability policy, which is the standard insurance policy that every business should have, or part of the standard insurance policy that every business should have, that has products and completed operations, which essentially states that as long as that policy is still in place, the work that they have done, it's guaranteed by them. Now, that's not to say that regular wear and tear is covered under the insurance policy and that the contractor is responsible for coming back and fixing regular wear and tear. But yeah, you do run into a bit of a gray area there where it would be covered and what it would fall under. But I wouldn't say that there would be a maintenance bond issued for frequent visits by a contractor to a facility to maintain it. That wouldn't really be where the maintenance bond is falling under. And like I had mentioned before, when those 50-50 bonds, the performance and labor material bonds, are issued, standard is 1 year. It can also be extended to 2+ years. There's a maintenance period included. And, you might see in the example of painters, there might only be a maintenance bond requested. So they wouldn't, the owner wouldn't ask for a bid bond. They wouldn't ask for a performance or a labor and material bond. But once the job's complete, they might ask for a maintenance bond. And during the qualification phase, they would probably want to ensure that that's actually possible from the contractor. If they don't do that, then they're putting themselves in a not a very good situation where they're going to get a contractor to complete the job, and then once they're almost done, they're going to say, "Okay, you guys are almost done. Now we need a maintenance bond in place." And they're going to say, "What? What's that?" They might not even know. So that's somewhere else where a consent of surety could come into play. Which again, I don't think I've ever issued a consent of surety that guarantees a maintenance bond upon completion. It's usually for the actual like contract period bonds, but it depends on the industry.
Right. I think one other question that I kind of have in the back of my mind is, it kind of seems like with all these different bond products that are available on the market, each of them serves a purpose, and they kind of have a hierarchy. Like we've kind of went right from the bid bond all the way through to the maintenance bond. Is there a catch-all bond that literally encompasses all of those bonds mentioned that requires one single piece of paperwork? And why wouldn't a contractor or an owner ask for everything that we mentioned? Is it because it's a cost thing, a time and like you're consumed with paperwork thing? Because it seems to me like if I was getting somebody to perform on a contract for me that was in excess of $1 million, that I'd want to have all of those things in place. Because if you're on a large enough project, you're going to have painters, which you're going to want to make sure that there's that maintenance in place. You're going to have all this stuff. So why wouldn't we see this more often where everything's offered? And is there a product that does catch all of it?
Well, you can think of it like sort of like, I think they call it a modal train, or where you can put in pieces and pull out other pieces. There isn't a one single product that catches all of that, but during the tender or in the tender documents or the contract documents, when it's stating their bonding requirements, if they wanted to catch all that, they would just include that as part of the documents. They would say all of these things need to be included. There isn't a single product that's doing all of that, and one of the reasons is because, well, every contract's unique. Every contract's a different value, and every contract's unique in both what's going to be done as well as the guarantees that the owner wants to see.
Right.
So that's why that doesn't really. And then from a surety's perspective, it's more difficult to underwrite that and more difficult to keep track of. Even though you could say it's under one bond document, the wordings and things like that, it makes more sense to remain the way that it is, I think.
Fair enough.
Yeah.
I just thought, why not ask? It seems like it could potentially be something out there for that, but
yeah, why don't we hadn't talked about what the costs are yet.
Yeah.
For contract bonds.
I think get into the costs, and then I think that would be sort of a great place for us to wrap up and leave off for part 2, as we're starting to see some overlap in insurance, and we can definitely get to that next time. But by all means, please outline the cost. So if we just quickly revisit the commercial license bond, BC specific, but let's assume throughout Canada and the US, costs, I don't know if they would fluctuate. I mean, obviously it's going to be different, but I don't
they're pretty minimal.
Yeah.
For these small scale bonds, the penalty amounts are small. The premiums, which when I say premiums, that's the cost for people that don't know. The premiums are small too. For contract bonds, it's a little bit different. And the costs can fluctuate greatly depending on your financial situation and the 3 C's that we had talked about before.
Right.
To set up a contract bond facility, when you're, starting out looking at bonding for the first time.
And just to be clear, the bond facility is the quote unquote annual subscription
to be able to provide bonds. Yes, right. That's correct.
Okay.
So that has a cost that is on a fee basis. It will be a determined amount from the surety company based on what your situation as a contractor and a company and personally is. They might say, and how difficult the underwriting is. If they are looking into all these different companies and all these different financial statements, them tying up employees and time to review all of these things, it costs money. And they don't charge for them to look at it, But if once they look at it, they're ready to proceed with offering you a bond facility with determined limits, then they do charge. And it varies. It really depends on the surety company, but I would say a safe number for most contractors looking at bonding to gain that ability to provide bonds throughout the year, they'd be looking around $3,000. That would be the annual fee that they would forfeit to the surety to enable the ability to provide bid bonds, consents of surety, performance, labor, material, and maintenance bonds. And I've seen it go as low as $1,000 for a very large scale company, for example, or one that might not even be large scale, but they're just in a very nice financial position. And the surety company, looking at the statements and looking at personal finances and assets and things like that, just felt super confident in this business, their ability to pay out in the event of a default, and their ability to perform on the works that they're looking at. They might say, you know what, this one, the fee for the year is just $1,000. And with that, I've seen them go as high as $7,500. But I think an average amount that you'd be looking at, and a safe amount to set aside if you're a contractor looking at this for the first time, is $3,000. I think for most contractors, it's going to be that, or potentially a little less. And you know, when we had talked about reviewing financial statements and things like that, we hadn't really gone too much into detail about how you're going to get approved. You obviously need to be profitable. They want to see profits. But kind of a minimum for you to get bonded in terms of a financial position is $100,000 in equity and $100,000 in working capital. And there's a financial statement review that the surety company is doing. They plug it into a spreadsheet with all the numbers in your statements. Hopefully they're review engagement statements, but sometimes they'll take these notice to reader or potentially even in-house statements if, you know, they're confident in the contractor's other C's, like the character and capacity. They might consider accepting notice to reader statements or even in-house statements for that type of thing. Now, I should say with these requirements, that's going to get you like a $500,000 limit, like a $500,000 single job and aggregate limit with those minimum amounts of $100,000 in equity and working capital. That's pretty standard, I'd say, in Canada. But there's other surety outfits, other surety companies that have workarounds for stuff like this. Now, they're not the big names, and we can talk about some of the big names. Trisura Guarantee Company of North America, Intact Insurance, Travelers, Echelon Insurance is one of the more recent surety outfits, although they've been insurance for a really long time. You know, there's probably a good 20 to 30 surety companies that are the real big names in Canada that most owners are comfortable accepting documents from. Right. And we got off on a bit of a tangent here on what we'd need to be looking at again for bonding approval to get that contract bond facility, and not directly related to costs. But I just wanted to state that there's workarounds. Like if you're newer and maybe your financial statements aren't looking so hot, you can still potentially obtain bonds for smaller jobs through alternative methods of guarantees. What your credit score is, things like that. There's other surety companies that look at things like that for one-offs for these small contractors that are trying to get their first jobs that are smaller so that they can remain competitive. Because it's important to keep in mind that the larger contractors, a $200,000 job is pennies to them potentially. Right. And the margins might be very small, and it might just be a headache for them to complete something like that. So they might pad it huge. They might put like a massive profit margin on that, which isn't favorable to the owner. And then one of these small guys can come in that can just barely get a bond for that amount, and they have a 15 or 20% margin, and that's who's going to take the job. Hopefully they are a contractor that is capable and caring enough to perform like the bigger, more experienced contractor would. But once you pay for that initial bond facility setup fee for a year from that date, and renewing every year thereforth, which the facility fee amount would be charged again, you can provide most of the time unlimited bid bonds and consent of surety for tenders that you are qualified for. So if the surety is confident, if you're an electrical contractor, all types of electrical work that you have showed experience in or expertise in enough to complete, they will provide the bid bonds and consents of surety for no charge. You can bid to your heart's content. Continue to bid until you win one of these jobs. Now, that being said, you can't throw out 5 bids. If you have a $500,000 single job and $1 million aggregate limit, you can't throw out 5 bids in a single week that are all $400,000. That's in excess of your aggregate limit. If you win all of them, what happens then? You don't have the capacity, most likely, or the capital, probably, to complete all of those jobs. So when a contractor's bidding on projects, they only want to bid on ones that they think that they're going to win, because it ties up their bond facility limits in how much potential work on hand they could have at any given time. So that's important to consider if you're a contractor and you're looking to bid on these jobs. You should bid on ones that you think you're going to be profitable on. And, if it's closing on Friday and you decide you're going to bid it on Monday, and then there's another one next week that you're going to bid on Tuesday, the following week, that's okay, because if you win this job, you can just pull out of the other one. And if the bonds are already issued, it's fine. If me as a surety or bond provider, and I'm the one that's going to be issuing these bonds, I act as attorney, in fact, for the surety company. So I'm the one signing off on these bond documents, sending them to the contractor to provide with their tenders. If they win the job on Friday, and then they say, okay, we don't have enough, we don't have the capacity to complete this other one that's closing Tuesday, even if the bond's already been sent over to them, we might just tell them, hey, don't bid on that next job. Or they might decide themselves, we're not going to bid on that next job because we're tied up with this other one that we just won on Friday. That's very common. Happens quite frequently.
Right. And what would be the ramifications of somebody that just says, screw it, I'm going for both. They end up winning both. And now they're over capacity. Does that mean that the surety company can force them to withdraw from the second contract?
No, because forcing them to withdraw would be a loss. They would need to pay that 10% on the bid bond if there was a bid bond issued. Right. So what would happen more likely is that they would either not issue the second bond, or, like I had mentioned before, issue the second bond and send it to them just because they need to have it ready for the next Tuesday and say, you are not allowed to submit this tender unless you are unsuccessful on the one on Friday. And in surety these days, it's funny, for municipalities and stuff, they still do public openings for some of them. And they will open the envelope on site and read out loud the bids of the contractors. And the contractors stand in a line or sit at a table and listen to all the other contractors that had bid on that job. And they know right there on the spot if they won the job or not.
Or how much they left on the table.
Exactly. So that's kind of fun. And I've been to a couple of those, actually. Just there's not really a reason that I would be there, just other than being present for something like that. It's just interesting.
No kidding.
But yeah, a lot of the contractors that bid on all these municipal works, it's a bit of a club as well. They all know each other. Some of them are even friends, even though they're competitors. They might give them advice, say, hey, I can't bid on this one. I'm tied up on this job until that date. Why don't you take this one? I'll take the next one. Things like that. That definitely happens.
Yeah. And that right there just underscores the importance of, I wouldn't necessarily say keeping your enemies close, but making friends in the industry. And I think that's of huge importance, especially when you get into these niche pockets or areas where there is sort of a bit of a club and it's the same people showing up to every job. And it's important to keep those people on your side, so to speak, when it comes to things like that, for sure.
There's a lot of work out there.
Definitely. We're in a huge labor shortage right now. I mean, they're screaming for people. So
yeah. And so we had chatted about the bond facility fee itself. We had talked a little bit more about the qualification process because I wanted to outline that if you don't have those minimums that we were talking about for the smaller jobs, the 100,000 equity and working capital, there still might be a solution for you as a contractor. And you could be good or just as good or even better than the next guy that is more than qualified financially to quote or provide a tender for something like this. So the next cost that needs to be considered for bonding is when you are successful on a project and you're going to be issuing one of these final bonds, like the 50-50 bonds that we had mentioned before. Those do cost. And it's on a contract value basis. So, for example, 50-50 bonds, a standard rate in the industry for the cost of those bonds, and that is the financial guarantee from the surety company on behalf of the principal to the owner of that project, is between $10 and $15 per thousand of the contract value. So if you are and that rate between $10 and $15, which is a standard rate, it can go significantly lower than that. I've heard it going as low as $2.50, which is pretty crazy. That's like a massive multinational company. I've heard it going as high as $25. And that's per thousand of the contract price for the financial guarantee. And that's on an annual basis. So that is for up to 1 year. And you don't pay any less or any more if it's a 5-month project or if it's a 9-month project. It's the same. But once you reach the year mark, on a per month basis, there could be excess premiums charged based on what the rate is. And again, that rate is determined on your financial position and is determined at the point of approval of the bond facility.
Right.
So you'll have rates outlined for the year. And if there is only a performance bond being issued and not a labor and material payment bond being issued on a project, the rates might be different. Standards that I see, if you're obtaining a $10 rate, which is that's a good rate. If you have a $10 per thousand rate as a contractor, it's good. That's a good rate. You'll stay competitive. I would say that's kind of where majority of contractors are lying on their final bond rates. But again, if you only want the performance bond issued, it might be $7 per thousand only.
Right.
And then the labor and material bond aspect would be $3 per thousand in that case, if the total was $10 per thousand. And it is determined like that.
And like you mentioned, if your facility contract is coming to a close, let's say midway through a multi-year project, is that something you're going to have to take into consideration in your tender price, that you may have different rates for the following year?
That's something that we hadn't touched on actually. And that's maintenance, not to be confused with a maintenance bond, but maintenance of the bond facility. The surety company wants to see probably quarterly your in-house financial statements. So they're going to know where you are. They're going to know throughout the year where you are. And part of my job as the broker is to negotiate rates with the surety company, so I know that the contractor is not getting jerked around on rates. If I have another surety partner, because I work with various surety companies, if I have another one that's going to offer them lesser rates, and it is a relationship business, so you don't want to just move people around for the best deal all the time. And you'd find that most likely, if one surety company is willing to lower the rates based on a company's financial position, the other one, to keep the client, is probably going to want to lower those rates too. So fighting over rates is not the most common thing in surety. And it's kind of frowned upon within the industry to move due to rates. I know some surety underwriters that would say they would not steal a business over rates. Maybe it was a servicing. Maybe it was that the other surety company just didn't have the capacity for either the type of work or the values of jobs that they were looking at. Although that when we're getting into that, that's like those are going to be big numbers, not a $5 million contract even. It's going to be much, much more than that.
Got it.
Yeah. So, those are rates for contract bond facilities and for final bonds. The maintenance bond is going to vary greatly as well. And again, in my experience, those are less common, but I would say that they're probably going to be less than that $10 per thousand rate. And, something else to consider is, this is a funny thing that happens in the surety industry. If a consent of surety is issued, that's that pre-qualification document that's issued in the tender phase that says that they're going to require or provide 50% performance and 50% labor and material payment bond if they're successful. And then to cut costs, after the contractor is successful on a bid, the owner says, oh, actually, we don't need the final bonds. We don't need that performance and labor and material payment bond because it's going to cost them another $40,000. And if they don't pay it, they're going to save $40,000 because they don't have to pay the contractor that because the contractor doesn't need the bonds. Surety companies are aware of this and they charge a penalty. I usually see it between $2 and $3 per thousand. If the owner says that they are going to require the final bonds, they make the surety issue the documents saying that they'll provide the final bonds, and then they go back on their word and say, actually, we don't need those bonds. There's a penalty fee that they'll charge, which ultimately the owner will end up paying because they're going to charge it to the contractor, and then the contractor will include it as part of their costs on that project. But that's something else to consider during tendering and when you're issuing these different documents.
Fantastic. Well, I think this is probably a good place to wrap up. You've deconstructed a lot of bonding and the industry in general for myself. I know this is something that a lot of people probably think about. And just to kind of quickly recap, any smaller companies are probably only going to have to worry about the commercial license bond. And then I think now would be a good time to ask you if somebody is getting approached through a contract or through a bid or something like that where they're required bonding, where's the best place for them to turn?
Yeah, I mean, I'm always happy to help new contractors or established contractors that are looking at bonding, whether they want a review of their current bond facility or if they're looking at getting into it for the first time. I'm happy to help and do any explanations and elaborate on what their questions are. They can go to my website, netsurance.ca. There's pages specific to different bonding products that they can have a look at on the website there. And there's applications that will give us an idea generally of where they are as a company for the specific type of bonds that they're looking for. For electrical and gas contractors, and we're extending this to other contractors as well. We issue the license bonds through the website. You can even get the instant quote and buy it online in the browser. And for the time being, we're still sending out the original document, like paper copies with the wet seal and signature like we had talked about before. But I'm in talks with the local safety authority here in BC of them beginning to accept digital signatures and seals from both the contractors and the surety companies. So that's in the works as well. But yeah, we're happy to help them through the website and personally, email, phone calls, in person. Happy to do so.
That's fantastic. And I guess from being in the industry for so long, is there any resources, books you may have read, or websites that you would recommend somebody check out for more information on the subject or to get familiar with bonding in general?
To be honest, I find that there's actually, especially in the online space, there's a lack of information available. And we're always working to improve the education piece online so people can do the research themselves. if they want to find out more about a bid bond or more about a bond facility in general, or even just more about the smaller commercial bonds, our website is a good resource for that. And I've recently started blogging, and definitely surety is going to be one of the topics of blogs that is sort of an education piece. But right now, the content on the website is sufficient for people to get a general understanding. And I would say that that's the best resource that I would recommend. The surety specifically is behind in the digital space, especially in Canada. Electronically and online, and just as a general education process, there's few resources available. But I think that our website does a pretty good job, and we're offering other commercial bonds, some of them that we hadn't chatted about too. Like recently, Government of Canada released that they're requiring an excise bond for cannabis producers, for example. And we're offering that through our website as well, which the underwriting process, although that is a commercial bond, like we had chatted about those electrical and gas contractor bonds, the underwriting process for that one is more similar to a contract bond. They want to see financial statements, see financial backing, see experience. It's funny that, a few years ago, that would have been something that's illegal. So I don't know if experience in the field is necessarily the best thing. But hey, we're not here to judge or anything like that. So I would say that our website's a good resource for stuff like that.
Awesome. And do you have any final suggestions, recommendations, thoughts, or small pieces of advice you'd like to impart on anybody that is getting into contracting for the first time, or maybe they've been in it for a long time? Is there anything that you'd like to say?
Well, keep working hard, I would say to the contractors, but to the surety industry in general, I want to say we need to update and modernize everything that's going on here, because sending original pieces of paper, having the ability to lose them, for example, what if an owner loses they're not perfect. What if they file something and it goes missing? I just want to see more digital seals and signatures, and we can make them reliable. Even more reliable than a wet signature, in my opinion. So I'd like to see that from the industry. And I look forward to the next chat where we'll get into insurance and maybe touch on a few other questions that people may have about bonding after they listen to this one.
Awesome. Well, thanks a lot, buddy, and we'll catch you over on the next episode. Woo! Hey, friends, Colin coming right back at ya. I hope you enjoyed this episode and are enjoying the tools of the trade. Do you think you could help me out? Pause this right now, go back into your podcast player, leave me a 5-star review, and then share this with one person you think could benefit from it. And now that you're back, I highly recommend checking out the detailed show notes on each one of my guests over at toolspodcast.com. And while you're there, join in on the conversation on your favorite episode, follow me on social media, and sign up for the newsletter. Much love to all of you guys for the support in my journey. We are construction. And don't forget, there is no proof that life is meant to be taken seriously.